Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Klaviyo Inc. annual report. Klaviyo, a technology company, offers a range of services through its software-as-a-service platform. The company's primary offerings include email marketing tools that enable personalized marketing emails with drag-and-drop templates, smart send time features, and a /B testing capabilities. In addition to email marketing, Klaviyo provides short message services, SMS, for targeted text messaging, as well as push notifications for engaging with consumers. These services are designed to help businesses connect with their customers through various channels. The company also offers other applications, such as reviews, which collect product feedback from customers. Furthermore, Klaviyo's customer data platform allows businesses to manage and sync their customer data across different systems. Overall, Klaviyo provides a suite of services that cater to the needs of entrepreneurs, small and medium-sized businesses, mid-market companies, and enterprises alike. Unfortunately, I don't have access to the extracted summary. However, I can provide a general essay on what might cause a stock price to crash. The sudden and drastic decline of Klaviyo Inc.'s stock price over the past year is a concerning trend that warrants investigation. Several factors could be contributing to this downturn. One possible reason is the company's failure to adapt to changing market conditions or consumer behaviors. As technology continues to evolve at an unprecedented rate, businesses must stay agile and responsive to remain competitive. Another potential cause of the stock price crash is the increasing competition in the email marketing space. Klaviyo may be facing stiff competition from other established players or new entrants that are offering more innovative solutions or better value for customers. This increased competition could lead to a decline in market share, revenue, and ultimately, stock price. Additionally, regulatory changes or scrutiny could also be impacting Klaviyo's performance. As the digital landscape continues to grow, governments and regulatory bodies may be imposing stricter rules on data collection, usage, and protection. If Klaviyo is not adequately prepared to comply with these regulations, it could face significant financial penalties or reputational damage. Lastly, internal issues such as poor management decisions, operational inefficiencies, or a lack of innovation could also be contributing to the stock price crash. Companies must continually invest in research and development, talent acquisition, and process improvements to stay ahead of the curve. If Klaviyo is not prioritizing these areas, it may struggle to maintain its market position. In conclusion, the decline of Klaviyo's stock price over the past year is likely due to a combination of external and internal factors. To recover, the company must address these issues through strategic planning, innovation, and adaptability. Klaviyo Inc. market capitalization of $6 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Klaviyo Inc. holds a significant advantage in their industry. Klaviyo Inc. trades at a higher price-to-book ratio of 5.58 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 19% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through an examination of Klaviyo's financial report. The key factors contributing to revenue growth include subscription fees, tiered pricing structures, and variable consideration incurred by customers who exceed their allotments. These elements have contributed significantly to the company's revenue increase. In addition to these primary drivers, geographic expansion has also played a crucial role in Klaviyo's revenue growth. Revenue from the Americas region increased by 26.4% from 2023 to 2024 and 43.8% from 2024 to 2025. Similarly, APAC revenue grew by 34.2% from 2023 to 2024 and 33.6% from 2024 to 2025. EMEA revenue also saw substantial growth, increasing by 53.4% from 2023 to 2024 and 54.5% from 2024 to 2025. While these factors have contributed to Klaviyo's revenue growth, the company has also experienced significant deferred revenue, with $29.6 million in 2025 and $20.5 million in 2024. This indicates a substantial amount of revenue that is yet to be recognized. Net income has been a concern for the company over the past 3 years. Initially, it reported significant losses of -$308.2 million in 2023. However, there was a slight improvement in 2024 with a loss of -$46.1 million. The trend continued into 2025, where the net loss decreased further to -$31.8 million. The profit margins have also undergone changes during this period. Gross profit margins saw a decline from 76.4% in 2024 to 74.7% in 2025. This decrease is attributed to increased adoption of text messaging and WhatsApp messaging offerings, which come with higher communication costs. The company expects its profit margins to continue declining modestly due to these factors. The reasons behind the changes in net income and profit margins are multifaceted. Increasing operating expenses and investments in business growth have put pressure on the company's finances. Additionally, regulatory risks, customer dissatisfaction, security breaches, and technical difficulties have also contributed to the decline. Furthermore, the anticipated increase in net operating losses, NOLs, due to executive option exercises and tax legislation impacts from the OBBBA has added to the financial strain. The company's financial performance is a testament to its ability to generate positive operating cash flow. According to the provided data, in 2025, the company reported an operating cash flow of $218,007, indicating a significant increase from previous years. A closer look at the numbers reveals that the company has been steadily improving its operating cash flow over the past 3 years. In 2024, the net cash provided by operating activities was $166 million, while in 2023 it was $119 million. This upward trend is a positive sign for the company's financial health. The substantial increase in operating cash flow in 2025 suggests that the company has successfully implemented strategies to improve its cash generation capabilities. This achievement is likely to have a positive impact on the company's overall financial performance and provide a solid foundation for future growth. The company's debt level and interest expenses have undergone significant fluctuations over the past 2 years. Initially, a notable decrease was observed in interest expenses, dropping from $340,799 in 2023 to $135,212 in 2024. This reduction suggests that the company successfully managed its debt obligations or renegotiated loan terms. However, this trend was short-lived as interest expenses rebounded in 2025, increasing by $26,819 to reach $162,031. This uptick indicates a reversal of fortunes for the company's financial management, highlighting potential challenges in maintaining stable debt levels and interest payments. The performance of various segments and regions was a mixed bag in the recent period. On the positive side, the e-commerce vertical showed significant growth, as did enterprise and international adoption. Larger customers in international markets also performed well, with increased usage across multiple offerings, channels, brands, and geographies. The United States, European Union, United Kingdom, Australia, mid-market businesses, and enterprise businesses all saw revenue growth. In terms of regions, the Asia-Pacific region and Americas also experienced revenue growth, although the latter was driven by both the U.S. and other countries in the region. However, not all regions performed equally well. Small businesses struggled, while Europe faced challenges due to onerous labor regulations. Emerging markets were also impacted by longer payment cycles and difficulty enforcing contracts. The performance of certain segments and regions was further affected by external factors such as general economic conditions, public health crises, responses to tariffs and trade conflicts, and fluctuations in foreign currency exchange rates. Despite these challenges, the e-commerce vertical and international adoption continued to drive growth for the company. Management's outlook for the company is one of continued growth and expansion. The primary source of revenue will remain subscription fees, with a focus on driving business operations through technology. The company plans to expand into new industry verticals such as education, events, restaurants, and travel, while also investing in innovation and product development. Internationally, the company sees significant room for growth within retail and e-commerce, as well as other industries. They are focused on expanding globally, with international sales already accounting for 35.1% of revenue. However, this expansion comes with increased costs, particularly in platform infrastructure and customer acquisition. Despite these challenges, management is confident that gross profit will increase over time due to rising revenue. The company also has sufficient operating cash flows to support liquidity and financing needs for at least the next 12 months. Overall, management's strategy is centered around driving growth through expansion, innovation, and internationalization. The company has reported a limited number of acquisitions and divestitures over the period covered by the summaries. In terms of acquisitions, one notable transaction was recorded on page 81, where business acquisition costs totaled $2 million in 2025. However, it is worth noting that there were no acquisitions mentioned in several other pages. In contrast to acquisitions, the company's divestitures are even more limited. While most pages report none mentioned, one notable transaction was recorded on page 100. This involved the conversion of redeemable common stock into a large number of shares of Series B common stock upon the effectiveness of the company's registration statement with the SEC in September 2023. That concludes the financial summary for Klaviyo Inc. Feel free to comment below, and I will be happy to answer them when possible.